Hi, Professor.
Hey, how are you?
I'm fine. How are you?
Good.
Yeah, I just have a quick question.
Go ahead.
Yeah, I was going over like the spreadsheets, and I was just wondering, how do you adjust gross cash yield to net with stock issuance?
If you have stock issuances, you net them out against buybacks. So we have, let's say, 500 million in stock, in buybacks and 100 million in stock issuances. Net, you raised only 400 million because some companies are issuing shares and others are buying it back.
I see. Thank you, Professor.
Okay, folks, it's time and I'm going to get started. Before I start, though, a reminder that some of you might find unpleasant, but you know what's coming a week from today, right? You look at your calendars. What's coming a week from today? Quiz one.
Quiz.
So a couple of things about the quiz. One is it will be accessible for about 10 hours that day on next Wednesday. It'll start at about 4 a.m. New York time, going through 2 p.m. New York time. And the reason I'm going to open the window that wide is about 30 of you in time zones, which are 13 hours away, 14 hours away. And I want to give everybody a reasonable time. Because if we take it at the time of the class, some of you will be waking up in the middle of the night. That's not fair. The thing, though, is once you open the quiz, you have exactly an hour to finish the quiz. So you want to make sure that you don't open the quiz and then discover that you have other things you need to get done. So make sure you have an open hour to do it. And there will be class Wednesdays too. So the class will be only 1 hour long on Wednesday. So it won't be the full class because that's how it would have been in the regular classroom. So you have the quiz. It is going to be next Wednesday. I will send you an email with past quizzes and a review session I put together on the quiz. It's actually a recorded review session. And I will try to have additional office hours before the quiz, and I'll send you those times as well. But the one thing I want to point out that will be different about this quiz is all of the old quizzes. And in fact, when I say I'll send you past quizzes, I'm going to send you every quiz I've ever given in this class, which goes back almost 30 years. So there are a lot of past quizzes, but those quizzes are all given in the classroom, and they're traditional quizzes, open-ended quizzes, because I grade the quiz, I give partial credit. Unfortunately, with an online class this big, having open-ended questions, and I've tried it, is a complete and total disaster. So they're going to be multiple choice, but the multiple choice questions are going to look a lot like the open-ended questions. If you prepare based on the old quizzes, you're going to see the same type of question. The only difference here is rather than you working out the answer as the answer, I'm going to give you 5 possible answers, one of which obviously is the right answer. And if you work through the problem and you come up with that answer, of course, you pick it. And this is both good news and bad news. The good news is if you come up with the right answer, it's going to be one of the 5 numbers there. So it's going to be a good way to check. But the bad news is that there are lots of wrong ways to do the problem. And those 4 other answers you see will not be completely outlandish. There'll just be different mistakes you can make. And because it's all or nothing, you're either going to get the points or you're not going to get the points. There's no partial credit. That I've checked with the school. It's almost impossible to have shades of gray in these multiple choice. So I will try to spread the points out so that you're not looking. So there are 10% on the quiz. I'm going to make sure that no question is going to be more than 2 points. So if you screw up on a problem, it's not bringing your entire quiz down. But that'll be next Wednesday. Again, sometime during the day, if you have an hour, take it. Time will not be the constraint. You can use, it's open book, open notes, open laptops. You have everything in front of you, okay? Not open consulting. So you can't 3 of you sit together and try to do the quiz together. That's not okay. So make sure you are in a place where you are by yourself, the honor code kicks in. But there's going to be plenty of time. You'll have so you don't have to memorize equations for the quiz. You just have to know how to take the equations that are in the notes and apply them. So that's next Wednesday, okay? And as I said, you'll hear a lot more about the quiz between now and next Wednesday. Needless to say, I will nag you, I will harass you so that you can get the prep going. Any questions on the quiz before we continue? And if you can't make the quiz, remember what happens. The 10% gets moved to the remaining quizzes. So it's not, if I miss the quiz, I lose 10%. It'll be moved to the remaining quizzes. And you will lose that option you would have had if you took all 3 quizzes, which is if you took all 3 quizzes, and you did really badly on one quiz, I would have replaced that bad quiz with the scores on your remaining exams. So if you don't take a quiz, that's your option use, but it's not a game ender. If you feel that there's something, something that will keep you from taking the quiz on Wednesday, that's okay. Just make sure that it is a good reason, that you're not just doing it because you're not ready. Okay, so let's start with today's test. Today we're going to finish discount rates and move on to cash flows. So I have a couple of things about cash flows that I want to focus on. So let me start with a very simple issue. Almost every cash flow calculation I'm going to show you is going to start with accounting earnings. And let's face it, your mission in your project is to value a company right now. Not value a company as of January 1st, 2020 or 2021. I couldn't care less because I can't go back in time and buy stocks on January 1st, 2021. It says right now, which means your valuation has to be of right now. Hang in there with me because I'm stating the obvious. So you want every one of your numbers to be numbers as of right now, right? So if I asked you to value Coca-Cola today, what's the risk-free rate you should be using? Patrick McNair, if I'm valuing Coca-Cola today, what's the risk-free rate I should be using?
I mean, risk, you can use SOFR or the T-bill rate.
As of when? If I'm valuing it today, I want today's rate, right? The T-bond rate, I'm
Right.
going to do today's rate. If I want an equity risk premium, I can get an updated risk premium. So I can get today's number. Why? Because I'm valuing it today. But then I look at revenues. What's the problem I'm going to run into? Accountants don't update revenues every day. I'm stuck with these accounting statements that from the past. In fact, if I take the last annual report for Coca-Cola, you know what year end I'm going to see on it? 2019. The 2020 annual report is not out yet. That's a lifetime ago. So you want the most updated earnings number you can for Coca-Cola, right? I'm going to give you a few choices. And Sriram, you're going to be my guinea pig on this one. You have to tell me which of these is the best way to get an updated earnings number for Coca-Cola. I can look at the last annual report at 10K. I've kind of given away the answer. What's wrong with that? It's from 2019. Clearly too old. Can I take the last quarter's numbers and just multiply by 4? It's updated, most recent quarter. Can I just multiply it by 4? Revenues times 4, earnings times 4.
You would lose a decent amount of information. So like seasonality, for example.
Okay, so if this is a quarter where there was something strange going on, it was seasonal. So I can't take the last quarter and multiply by 4. Can I create my own updated 12-month number for Coca-Cola? I mean, they report quarterly reports. What if I bundle 4 of them together? You know what I mean by 4? The last 4 quarterly reports put together. That's called trailing 12-month numbers. What that gives you is the most updated number you can as of right now. And I've seen people actually sometimes do the following. Let's say the first 3 quarters of 2020 are in the books. You've got reports. You can take an estimate for the last quarter of 2020, because by now people are making estimates, add them up and come up with kind of your own version of 2020 numbers, even though it's not been officially reported. I can live with C or D. B is definitely off the books, never ever multiplied. And A is something that can lead you down a very bad path. We're going to talk about trailing 12-month numbers and what to do in markets where you can't get them, because not every market has full quarterly reports every quarter. But we want the most updated numbers we can. We'll come back and talk about this, but let me ask you let's do a follow-up to this. You remember your accounting class where the accounting professor talked about what a capital expenditure was? In case you were sleeping through that session, let me repeat what I heard in my accounting class about CapEx. I was told capital expenditures are any expenditures that create benefits over many years. That was the accounting definition of CapEx. So that's the accounting definition. I'm going to list off a bunch of items, and you tell me whether they meet this definition of capital expenditure, an expenditure designed to create benefits over many years. So is building a new factory going to be a capital expense, Rodrigo?
Yeah, it is.
Absolutely. That was an easy one, right? I noticed you were nodding your head. So let me put a tougher task to you. What about R&D expenses?
I mean, I've heard a lot of interpretations. Some people say that R&D should be a capex, where other people don't.
Forget
but
about other people. If you use the definition of capex as an expense designed to create benefits over many years,
if you can reliably estimate the benefits, then yes, R&D
do
should
you
be a
have
capital
to
expense.
though? What if I build a factory where I'm producing a product in a very competitive market? Why does reliably even enter into the picture?
I mean, from an accounting perspective, then you're susceptible to overestimating the benefit and potentially skewing your
No,
numbers
treating
favorably.
something as a capital expense gives no benefits. All it does is bring in something into your balance sheet as money you've spent. The benefits come in revenues, earnings, cash flows. I'm giving you no, in fact, I'm handicapping you when I capitalize R&D. You know why? Because I'm going to count that as invested capital, and I'm going to keep asking you, when are you going to make money on it? So I know accountants keep saying, you're giving rewards to companies by capitalizing R&D. I've never understood this. What exactly is a reward by inflating your book value? R&D is capex. It is super capex. I mean, think of a pharmaceutical company doing R&D. If you're lucky, you might get benefits in 8, 9, 10 years. Moderna started the research that's paying off as the vaccine in 2012. It's finally paying off. So R&D is clearly a capex. It's screwed up by accountants. Let's face it, accountants do terrible things with R&D. But if you think logically, of course it's a capex. Marissa, I'm going to throw another item at you. What if you're a consumer product company spending money on advertising? Is that an operating expense or a capex?
Can I say it's capex because you can continue to benefit from that ad that you created?
You can say whatever you want. So let's back it up. So if you have a Coca-Cola and you see a Coca-Cola ad, now part of the reason you see the ad is they want you to buy more Coca-Cola today, right? That's part of the reason. That's an operating expense. But part of the reason Coca-Cola has these ads is to imprint in your mind a brand name. Coca-Cola's biggest asset is its brand name. How do you build a brand name? Through effective advertising. You could argue that is maybe not all advertising, but a chunk of advertising is a capex because it's designed to build your biggest asset. Rebecca, I want you to use that same logic on the next item. What about recruiting and training expenses at an investment bank or a consulting firm?
I could see it being defined as a capex because, like, it's not. It could be like
unless they fire you right away, right after the training, which some investment banks do. Yeah. I mean, let's face it, the biggest asset a consulting firm and investment bank has is human capital. It's not land, it's not building. And how do you build up human capital? Recruiting and training expenses are a big part of it. This is their version of capex. Let me do one final example. Let's suppose you're looking at DoorDash. You know, one of DoorDash's biggest expenses is customer acquisition costs. You know what form it takes? They've been offering all these promotionals. Try Dash for the next 3 months. We will pick up. So they're trying to get you to sign up. The costs of doing that, where they allow you to try. Then what's this thing that you get where if you do a monthly subscription, you don't have to pay that. But they offer it for 3 months free, so you can try it out. That's treated as customer acquisition cost. 1/5 of their expenses last year were customer acquisition costs. By now, I don't even have to put you on the spot, but you can see why that's like capex as well, right? Because why are you spending money to acquire customers? Because you hope they stay on for 2 or 3 or 4 years. That is your biggest asset. And this is how you invest. What I'm trying to say is accounting views capex much too narrowly. It's almost like, they stopped thinking about capex after manufacturing companies. And today, if you look at capex at many companies, it takes forms that don't take the traditional form of land, building, equipment, machinery. one of the things we're going to get to today, perhaps towards the very end, is we're going to talk about how do we capitalize these expenses. It's not rocket science, but what we're trying to do is fix the accounting inconsistencies. So let me shut that down and turn back to your lecture notes. We'll talk about tax rates next session, don't worry about that. And go back to where I left you. Oh, shoot. I did this last session too. This is not going to end well. Okay. Sorry about that. Every time I hit the presenter view, it kind of puts me into this bad scenario. So I'll get back here. Okay. Okay, so now I'm going to do this right. I'm sorry. Okay, so now let's talk about the cost of debt, which is where I left you last session. And let's talk about the basic number you're trying to estimate. Remember how we estimate cost of equity? We start with the risk-free rate, the currency we want to do the analysis in, beta and equity risk premium feed into a cost of equity. But now we're thinking about what does it cost me to borrow money? Let me lay the basic ground rule. The cost of debt for a company is the rate at which it can borrow money long-term today. Two keywords there, long-term and today. So when you ask me what's the cost of debt for my company, here's what I'm going to start with. I'm going to start with the risk-free rate. Why? Because no company should be able to borrow it lower than the risk-free rate. Otherwise, you have something wrong with your risk-free rate. And on top of that, I'm going to add a spread reflecting how much risk I see when I lend to your company, a credit risk or a default risk. So cost of debt is risk-free rate, long-term risk-free rate plus a default spread. So the entire process of estimating cost of debt boils down to how do I get the default spread? I'll start with the simplest possible scenario. And for some of your companies, this will work. If your company has a long-term corporate bond it has issued to the market that is liquid and traded, here's what you can do. You can take the yield to maturity on that bond and back out a default spread. I'll give you an example. A 10-year AT&T bond right now has a yield to maturity of about 2.5% right now. The T-bond rate is 1.3%. 2.5 minus 1.3 gives me a default spread of 1.2%. I can use that as my default spread for AT&T. It's easy, but there's a danger here. And to see what the danger is, you ask you a question. Can a risky company issue a safe bond? Veena, can a risky company issue a safe bond?
I'm not sure, but I'm guessing yes, maybe.
Yeah, because you issue bonds, you define the security backed in the bond, right? If you're a risky company, you take your safest assets and you back up a bond. You can be risky, but the bond can be safe. Do you see where I'm going? If I take an individual bond, look up the interest rate on the bond and attach to the rest of the company, it's not going to be the right cost of debt because that is the safest part of the company. But if you have a bond outstanding, I get a bonus. And here's the bonus. You have a rating as a company. Remember, companies don't have to be rated, but if you issue bonds, you almost always have it. You know what I mean by rating, right? S&P, Moody's, Fitch, they rate your company. Those ratings go from AAA down to D. AAA, of course, is the safest you can get as a company. D means you're in default. If you have a rating as a company, I'm home free. So if you told me your rating is BBB, I can tell you that your default spread is roughly 1.5%. How do I know that? I can look at other BBB rated bonds and see what they trade at. So the easy scenario for your company is if your company has a rating. Remember, I asked you if you got to get a chance to get on the Bloomberg terminal. I don't know whether any of you have been able to do it, but you don't even need access to a Bloomberg. If you go on Google search and say bond rating and your company name, if your company is rated, it should show up somewhere there. Moody's has a Baa3 rating for the company, or S&P has a single A rating for the company. You're home free because you can take that rating, come up with a default spread. But for 90% of your companies, you will not find bonds outstanding and you will not find a rating. Not because they don't borrow money, but because they borrow money using bank loans. So I'm going to take you through the process of how to get a cost of debt for a company that doesn't have a rating and doesn't have a bond. I'm going to use a process that I call it a synthetic ratings process, but don't let the words kind of lead you to think I'm going to do something sophisticated. I'm going to act like a ratings agency. And here's what I'm going to do. I'm going to assign a rating to you based on your financials, because let's face it, that's what ratings agencies do. In fact, if you look at the S&P website, they list out the 7 ratios they claim to look at to give a rating for your company. Things like interest coverage, earning EBITDA to fixed charges. You can look at the ratios. They say, those ratios look good, I'll give you a AAA rating or a AA rating. And I'm going to simplify the process by focusing on only one of these ratios. Which one? It's a ratio that best explains differences in ratings across non-financial service companies. It's called the interest coverage ratio. You remember what an interest coverage ratio is? From accounting, you might have seen it. You take your operating income and divide it by your interest expense. Earnings before interest and taxes divided by interest expense. You give me your income statement. This is trivial, right? For Embraer, for instance, in 2004, if you divide the operating income by the interest expense, you come up with an interest coverage ratio of 3.56. Let's face it. If I told you Embraer's interest coverage ratio is 3.56 and asked you, is that a high number? Is that a low number? Is that, I mean, who knows, right? I mean, it's a number. So I'm going to help you out by giving you some perspective based on rated companies. I have a table that I've been updating every year pretty much for the last 25 to 30 years, where if you give me the interest coverage ratio for your company, and whether you're a big or a small company in terms of market cap, I can guess your rating. Let's try. Let's assume you come to me with Coca-Cola. You say my interest coverage ratio is 5 and my market cap is 150 billion. My definition of large is market cap greater than 5 billion. So clearly it's a large company with an interest coverage ratio of 5. I'm going to go down and look down. There you go, 4.25 to 5.5. I'm going to give you a single A rating. You come to me with take two. Somebody's doing take two here, right? I mean, whoever's doing take two as their company. You tell me your interest coverage ratio is 1.5 and you're a small company. I'm going to go down and say 1.5. I'm going to give you a triple C rating. Basically, you give me your interest coverage ratio, whether you're a large or a small company. This lookup table allows me to come up with a rating for your company, and that rating translates to a default spread. Alex?
I was wondering, let's say you are looking at a company that has liquid bonds that are traded sufficiently enough to get a good yield to maturity. Would you look at secured bonds, unsecured bonds?
See, that's the problem. You can't see, because the cost of debt you should attach to a company should be for all debt. You want the bonds to be general obligation bonds. Because the minute you have secured bonds, the rate you're going to get is too low. If you have unsecured bonds, the rate will be too high. And that's the problem with focusing on an individual bond. If you have those bonds, here's what I would do. There's probably a rating for the company, use the rating instead. It's going to give you a much better estimate of the cost of debt than focusing on the yield to maturity in the bond. So even with liquid bonds, I would go with the rating.
Got it. Thank you.
Tim?
This you already mentioned that we really don't know how like what the interest coverage ratio really that number really means, but what is considered like a
No,
distress?
we know what it is, but
Okay.
until we have perspective, we can't convert it into is that high or low. That's what this table does.
Okay.
So
well,
until you
but-
get this table, you don't know what it means. But once you get this table, you can say that number is high, that number is low. This is what it will translate into in terms of a rating and a default
So
spread.
what range of the rating is considered like distressed?
Anything below triple B or below investment grade. Distress usually means you're below single B, even triple C. So distress means there's a very real chance you will not make it. But generally the cutoff is triple B. Triple B is considered investment grade. So in triple B and above, you're viewed as a safe company. As you start to drop below triple B, you get risky, and you start dropping below single B, you're in distress.
But just like the Embraer, like if the interest coverage ratio is low just because of the seasonal effect, like would
Then,
we? Okay.
But then you'd have to use common sense. Let's say I took 2020 numbers for Marriott. What's my interest coverage ratio going to look like in 2020 for Marriott?
Like super low.
It'll be negative, right? They lost tons of money. So if I take that negative operating income and said they're a D-rated company, I'd be missing the boat. So what am I going to do? I'm going to look at an average across time. This is something where an individual year might be a starting point, but if that year is strange like 2020, you might want to look at an interest coverage ratio between 2015 and 2000, because that's what the ratings agency would do as well. They're not going to swing the rating around based on individual year numbers. They're looking at income you can make over time.
Thank you.
Welcome. Chad?
So then what about like young companies that are consistently losing money where you have no positive interest coverage ratio?
How much debt do those companies have?
Probably a low amount.
Yeah, so why worry about it? Just give it any rating and move on. I mean, I'll take an example. Most young tech companies, we look at the debt. The debt will be so tiny, if it's there at all, it's probably not even worth the effort of finessing the cost of debt. I tell people use a single B, double B rating, just move on. It's not worth it if your debt ratio is 1%, 2%, which is what it will be. If you have a young company with a lot of debt, it's in serious trouble. It shouldn't even be having that debt. And then you should give it a really high cost of debt, and also attach a really high chance that they will not make it as a company. Multiple levels of, but usually, and thank God for this, most young companies with a lot of promise do the right thing. They don't borrow money. Or if they borrow money, it'll be a tiny amount relative to their market value of equity. And you can afford to be pretty sloppy about the way you estimate cost of debt because it's not going to change your cost of capital that much.
Okay, makes sense. Thank you.
Okay. Nick?
Yeah, I just want to say like there's someone whose mic is on and they're not noticing and it's making me crazy. I can't focus.
Whoever's got their mic on, could you please turn it off? I don't see it on this page. So if somebody has a mic on. Patrick, is that your mic or you've got a question? I think it might be your mic, Patrick. I'll mute you.
I was muted.
Oh, you had a question to ask. Sorry, I muted you. Go ahead.
Yeah, I was muted. It wasn't me because I was muted on my phone.
Okay.
But, yeah.
So whoever's got their mic on, please open, please shut it off because clearly the feedback effect can be disruptive. But Patrick, you had a question though? No?
No, I'm good for now. I'm good.
Okay, good. Okay, so let's talk about bringing this all together to the cost of debt for Embraer. Embraer, if you look at the previous page, at a 3.56 interest coverage ratio, which gives them a rating of A minus. So, I'm sorry, it gives them a rating of A minus. They're a big company, 3.56 interest coverage ratio, that gives them an A minus rating. A minus rating in 2004 at a default spread of 1%. So that is the default spread that Embraer would have to pay because it's a risky company. But Embraer has one more layer of pain to come, which is it's a Brazilian risky company. You're saying, so what? You're a bank, you're lending money to a company, and they happen to mention they're a Brazilian company. Whether you like it or not, it enters into your interest rate calculation. And the way it enters in is if you're a company in a risky market, whether you like it or not, you carry two burdens on your shoulder. One is your own risk as a company, the other is the country's risk. So to get the cost of debt for Embraer, here's what I'm going to do. I'm doing everything in US dollar terms. So I'm going to start with a risk-free rate in US dollars, 4.29%. Then I'm going to add the default spread for Embraer, which is 1%. But then I'm also going to add a default spread for Brazil as a country. Why? Because as a Brazilian company, whether you like it or not, you carry that burden. I didn't give them the full default spread for Brazil, which was 6%, because Embraer sold its stuff in the US and Western Europe. It got its revenues in dollars. In fact, it was less risky than the Brazilian government in 2004. It was able to borrow at a lower rate in dollar terms. So rather than give them the entire 6% spread, I gave them only a 4% spread because that's what they were paying in the market. The overall cost of debt for Embraer is the risk-free rate in dollars plus the default spread for Embraer plus the default spread for Brazil, 9.29%. So when you think about cost of debt, if you have a rating, don't look a gift horse in the mouth. You're done. Use the rating. If you don't have a rating, then you got to do the synthetic rating approach where you get the interest coverage ratio, go to that table, look up a rating and a default spread. I've been using this table for a long time to get default spreads, not just in the US, but in Latin America and Asia. And one of the pushbacks I get is this table was developed primarily with rated companies in the US. That's how I developed the table in the first place. Can I use it for a Brazilian company, a German company, an Italian company? And my answer is yes, with a qualification. These spreads are dollar spreads on a dollar risk-free rate. That's what these spreads are. If you're working in a market with roughly similar interest rates, then I think you can use those spreads. In other words, you're looking at European companies. I have absolutely no qualms about using these default spreads with European companies because the spreads tend to be roughly similar. But if you're a Zambian analyst working with Zambian companies and the risk-free rate is 10 or 11 or 12%, the spreads you're going to get from this table will be too small because you're building off a much bigger risk-free rate. We'll talk about what to do with those kinds of risk-free rates, but that's your only qualifier I would have. So cost of debt is based on a default spread, and that default spread can change over time. Remember that 2008 graph I showed you of the equity risk premium? How much it changed during the course of that crisis. Went from 4% to 8% back to 6%. During the same year, if I track default spreads, here's what I'd have seen. A BBB rated bonds default spread at the start of 2008 was 2%. By the end of 2008, after the crisis, it was almost 6%. It had tripled over the course of the year. It dropped back over the course of the next 2 years. But my point is, if you were a BBB rated company at the end of 2008, your cost of debt would have been much higher than it was at the start of 2008, not because you became a riskier company. Your rating stayed the same, but because the price of risk changed in the market. What that effectively means is you want to value a company as of today, you want default spreads as of right now. At the start of 2021, I updated my numbers, and I'm going to let you use these numbers. You don't have to update them, and I'll give you a way of updating them if you ever need it, because maybe in the middle of the year you want to come back to evaluation. At the start of 2021, here's what the default spreads look like. It's a very last. If you look at the columns, it's the very first column there. I know it's the sequence is reversed. And you can compare the default spreads at the end of 2021 to the default spreads, at the start of 2021 to the default spreads at the start of 2020. And one thing that jumps out, at least for me, is how little the default spreads changed in 2020. You know why that's striking? If you didn't know anything about markets, what happened to the stock market and the bond market, and I describe 2020 to you, let's say you're a banker, and I say, hey, here's what's going to happen in 2020. In February or March, the global economy is going to shut down. A lot of companies will have little to no revenues, big losses. You'd probably say, as a banker, that scares me. I'm going to charge a much higher default spread. That's a risky market. Well, that did happen in 2020, but the default spreads don't seem to reflect it. Again, for whatever reason, people seem to be looking past 2020 and saying, even though 2020 was a bad year, it's all going to be okay. We're going to get paid back. Whether that's true or not, we'll find out in hindsight. But the default spreads. No. And during the course of 2020, the numbers did jump around. Between January and March, if you look at what happened to default spreads, the default spreads tripled. A BAA rated bond saw its default spread go from 1.33% almost to 4%. But over the course of the rest of the year, it retraced that drop to come back to almost where it was before the crisis. So it's a long-winded way of saying, don't use stale default spreads. The numbers can change over time. Try to get the most updated numbers you can. And I'll give you a couple of places you can go get the most updated numbers for your company, for whatever rating it has. But you want the cost of capital as of today and a cost of debt as of today, and that requires an updated default spread. A couple of final loose ends on cost of debt, and then we can move on. Now, once in a while, you'll see your company borrow money at a rate that is astoundingly low, too low. You're saying too low relative to what? Relative to what they'd have paid in a normal market. Why? Because somebody's subsidizing the loan. Now, green energy companies for a long time around the world got debt from governments at subsidized rates. And Embraer actually is able to borrow money at a subsidized rate. And here's why. Embraer in 2004 was the crown jewel of the Brazilian government. It was viewed as this great company with technology and superior management. And the Brazilian government really liked it. So the Brazilian government gave Embraer some subsidized loans with a 6% interest rate. You're saying that doesn't sound that good. Remember, they'd have to pay 9.29% based on the default risk. They were able to borrow from the Brazilian government at 6%. So they got this cheap debt, too cheap at 6%. You could build that into your cost of capital. After all, it's cheap debt, you might as well build it. And if you build into your cost of capital is going to be lower because they have access to that subsidized debt. Or you can act like you don't have this debt and leave the cost of debt at 9.29%. So let me ask you a question. If you're looking at the cost of capital for Embraer, would you build in that subsidized debt into the cost of capital and lower your cost of capital? Because after all, it's cheaper debt. Emily Parks, do you want to try? Could you build in the subsidized debt into your cost of capital?
Can you repeat the question real quick?
Well, Embraer would have had to borrow 9.29% based on their risk. The Brazilian government is giving them this cheap loan with a 6% interest rate.
Yeah.
So when I do the cost of capital and I look at the cost of debt, should I give them the lower cost of debt? Because the Brazilian government is lending them that money at that lower rate. Go with your gut. You don't have to think through too seriously.
I'm not really sure. Could I pass it on?
Sure. Anybody want to try? Sebastian, what do you think?
I would say, I mean, if they could get those loans at that low rate again, I would.
That's exactly right. You have to be careful. If you lock it into the cost of capital and it's just for the next 3 years, and it's not going to be there for the long term, you don't want to build into your cost of capital. And no subsidy lasts forever. So here's my suggestion. If you have a company with subsidized debt, act like it's not there when you do your cost of capital. Value the company with a much higher cost of capital. And after you're done with the valuation, you can bring in the subsidy benefit separately, right? Because the subsidy benefit is very simple to value. It's the fact that you can borrow money at 6% instead of 9.29%. It's that difference. And you take the present value of that difference over time, you got the benefit in separately. In general, when you have subsidies, it's always good to keep them out of the valuation. And then when you're done, you can bring in the subsidies separately and say, this is the government subsidy. This is what it adds to my value. And this is when it disappears. So when you see debt that looks far too cheap and it's a subsidized loan, be careful not to bring it into your cost of capital and leave it in there forever, because then you're assuming the subsidy lasts forever. So let's review. Cost of equity comes from your risk-free rate, your beta, your risk premium. Your cost of debt reflects the rate at which you can borrow money long-term today. Last step in this process, you need weights for debt and equity. You know what I mean by weights. How much of your capital comes from equity and how much from debt? And I'll give you the two broad choices. You can use market value weights, market value of equity, market value of debt. You can use book value weights, book value of equity, book value of debt. That comes from the balance sheet. What does every finance textbook recommend that you do? I don't think there's a single exception. Every single finance textbook There's a consensus view on this. Which is the better debt ratio, market value or book value? Every book that I know of in finance suggests use market value weights. We've reached this consensus. So I'm going to ask you a question. It's a little unfair because if finance came to the consensus, it should explain it. But there's actually a reason for this. And I'm going to list out some reasons and you tell me whether this is the reason. Madhur, is it because the market is usually right? Is that why you use market value weights?
No, I don't think so. In fact, if anything, the reason we invest in stock markets is because they're often wrong.
Exactly. If I say the market is right, I'm kind of stuck, right? Because then if I use the cost of capital to tell you the stock is undervalued, you're going to turn on me and say, hey, you know what? You told me at the start the market is right. So that's not it. Is it because market values are easy to obtain, Chad Balak? Is that why we use market value weights? Maybe we're just lazy people.
No, you would think that book is just as easy.
Exactly, right? Just look at the balance sheet. So that's not it. Is it because we don't trust accountants? Well, that's always the case. We don't trust accountants, but that's a pretty, I'm going to give away the reason. It's something, hold this as your special secret and then hit somebody who does DCF around you, claims to be very experienced with the reason. Every discounted cash flow valuation is an exercise in acquiring the entire company today. Think about it. If you decide to acquire the entire company today, you'd have to go buy all the shares in the market and buy back all of the debt in the market today. And if you did that, what would you have to pay? Definitely not book value. You'd have to pay market value. This is a transactions cost. This is what it costs you to buy the company. And that's why we use market value weights. Markets can be wrong, but you still have to pay the market price, right? So if you decide to buy Tesla, you can't go to the market and say, I did an intrinsic valuation of Tesla, it's 200. Sell me your shares. Nobody's going to sell you the shares. It trades at 750. We use market prices because that's what you have to pay to acquire the company today. So I'm ready to do this for Embraer. It took me a while to get there, 80 pages of grunt work, but I'm ready to compute a cost of cap for Embraer in 2004. First, I'll give you my choice. I'm going to do the cost of capital in US dollar terms. Why? Because in 2004, it was very, very difficult, if not impossible, to get a risk-free rate in reais. I gave up on it. I'm going to do everything in dollar terms. Where does it show up? My risk-free rate is 4.29%. That is the US T-bond rate at that time. What a risk-free rate in dollars. Let's start with the cost of equity. I start with the risk-free rate. I have a beta 1.07. I know this was last session, but let me review where I got that. I got that by looking at global aerospace companies with a non-levered beta of 0.95, and then I levered it up using Embraer's debt to equity ratio. It's a levered beta based on the business they're in. I multiply the beta with an equity risk premium of 4%. You know what that was? That was the S&P 500's implied premium in 2004. I'm using that as my premium for a mature market. You think, but Embraer is a Brazilian company. I know. And here's how I'm going to bring that in. The 7.89% was the country risk premium for Brazil in 2004. Huge default spread, big multiplier effect. And the 0.27 reflects the fact that Embraer is not just another Brazilian company. It gets a big chunk of its revenues outside Brazil. It's less exposed to Brazilian countries. That's a lambda. Risk-free rate plus beta times mature market premium plus lambda times country risk premium gives me a cost of equity. Now, of course, if I don't want to do lambdas, I could have done a weighted average equity risk premium. I'd have got roughly the same number. But my cost of equity in 2004 with those ingredients is 10.7%. To get the cost of debt, we went through the process. Risk-free rate plus default spread for Embraer plus default for Brazil, 9.29%. But there's one thing about debt that makes it a better way of raising money for a company that has a choice. Interest is tax deductible. You're saying, so what? When I borrow money at 9%, if you allow me to deduct that 9% for tax purposes, my true cost of borrowing is not 9%, it's 9% net of the tax benefit. So when you do cost of capital, here's what we do. We take the cost of borrowing money, 9.29%, and we net out the tax benefit. The tax rate I'm going to use to compute the tax benefit is the marginal tax rate. You guys know and in fact, let me throw this out to the class. There are two tax rates that you'll see floating around a company. One's called the effective tax rate. The second is called the marginal tax rate. You know what the difference is? What's the marginal tax rate? Anybody want to try? The word I use actually gives away the answer. Marginal tax rate. Efrey?
Is the marginal tax rate the tax rate for each margin of revenue, and the
it's on the last margin of revenue. It's not even each, it's a very last dollar of revenue. It's on the last dollars of revenue. An effective tax rate is an average tax rate. When we do cost of debt, we use the marginal tax rate because interest saves you taxes at the margin. It's on your last dollar of income. The marginal tax rate in Brazil was 34%. I've got everything I need. I've got a cost of equity. I've got an after-tax cost of debt. For the weights, I use market values. The market value of equity was easy. I took the share price times number of shares. I got 11.04 billion reais. For the debt, I ran into a bit of a problem. Embraer, a big chunk of their debt is not traded, it's bank debt. If you ever worked in an investment bank, you know what they end up doing, right? They wave their hands a little bit and they say, you know what, market value of debt is too difficult to get. I'm going to use book value of debt as my proxy for market value. I don't want to do that. I want to actually try to estimate a market value. So here's what I did. I took the book value of debt, which was 1,953 million. That's on the balance sheet. I took the interest expense of the income statement, 222 million. And I acted as if this were a bond and I were trying to price it. You say, what are you talking about? Remember the 9.29% cost of debt I came up with for Embraer? If this were a bond with a 4-year maturity, here's how I'd price it. I'd take the coupons, 222 million, discount them back to the present at 9.29%. I'd take the 1,953 million, which is the face value, discounted back at 9.29%. You add those numbers up, you get a market value of debt of 2.08 billion. I've got 11 billion equity, 2.08 billion in debt. Translates into 84% equity and 16% debt. Just add the two numbers, come up with the weights. My weighted average cost of capital. There's a reason for every word in that. Please don't use the word whack. It just sounds incredibly crude. Either use cost of capital or use weighted average cost of capital. It's a weighted average cost of capital. Market value weights for Embraer is 9.97%. Took us a lot of work to get there. But basically it's at weighted average. That's in US dollar terms, right? Peter, at this stage, you've got a US dollar cost of capital. Peter Lutz. Now you've got a US dollar cost of capital in Embraer. Let's say you change your mind. You want to do everything in reais. Is there an easy way for me to convert a dollar cost of capital into a real cost of capital? We kind of looked at it when we talked about currencies. Is there an easy way for me to convert it?
I guess you could use the currency exchange, but I'm not sure.
And what drives the currency changes in currency exchange? Rodrigo, you want to try?
Yeah, would you use the inflation difference?
You got it. In fact, Peter was right. It's currency exchange rates, but the exchange rates are driven by differences in inflation. So here's what I did. I estimated an inflation rate of 8% for Brazil and 2% for the US. So if you look at the 8% for the, and if you're in a hurry, here's what you can do. 8 minus 2 is 6%, which means inflation in the real is 6% higher. My cost of capital in dollar terms is 9.97%. You can add the 6% to it. You'd end up with 15.97% if you're in a hurry. If you're not in a hurry and you want to do it right, there's a compounding effect that's got to be factored in. It's not a big deal, but it's worth going through. Here's what I'm going to do. I'm going to take 1 plus the dollar cost of capital. That's a 1.0997. But rather than look at the difference in inflations, I'm going to look at the ratios of inflations. My nominal real cost of capital, if I do the correct calculation, is 16.4, slightly higher than the 15.97%. But that is a more precise answer. This is an extraordinarily effective tool to have in your arsenal. And here's why it's useful. Let's say it's 3 years out, you're in the middle of an M&A transaction, you've done all your analysis in dollars, but it's an Indian company. And the CEO of the Indian company says, I don't get any of this dollar stuff. I want it in rupees. You give me a cost of capital in dollars. I prefer a rupee cost of capital because that's what I'm used to. You don't have to go back to your office. You can do it right there, right? Take the difference in inflation between the rupee and the dollar. You can convert a cost of capital in any currency to any other currency. Final couple of loose ends on cost of capital before we put this to rest. Now, if you look at my cost of capital calculation, there are only two components, right? Debt and equity. And I wish I could tell you that in every company you look at, there'll be only two components. And that's not true because there are some companies where you will see these rogue sources of capital, what are called hybrids, mixes of debt and equity. One classic is convertible debt. Convertible debt is straight debt with a conversion option to equity, where you can convert the debt into equity. I'm going to argue that convertible debt is actually easy to deal with. You can separate into debt and equity, and I'll show you how to do it in the next page. But the more painful way of raising capital, the painful for the people valuing companies, is what's called preferred stock. Now be very careful. In Latin America, what gets called preferred stock is really common stock without voting rights. But in the US, preferred stock resembles debt. Because when you buy preferred stock, you actually get a fixed dividend, like a coupon. You get no voting rights. So essentially, it is expensive debt because you don't get the tax advantage. The two biggest issuers of preferred stock are banks. Banks, because the regulatory capital guys treat preferred stock often like equity when they do the regulatory capital. And the other is very young companies that issue convertible preferred stock, and they don't care about the tax advantage because they're money-losing companies anyway. Most companies, though, are very light. I mean, this is a very, very rarely used source of capital. But if your company is one of those rare companies that gets a big chunk of its capital from preferred stock, I'm afraid you have no choice but to open a third source of capital. Debt times cost of debt, equity times cost of debt, equity, plus preferred stock times the cost of preferred stock. And the cost of preferred stock is very simple. You don't need a model. It's just the preferred dividend yield. Dividend on the stock divided by the price. So let's talk about convertible debt. You guys know how convertible debt works. I issue a bond, you buy the bond. Initially, you just get coupons and face value. But at any time during the life of the bond, you get the right to convert the bond into common shares at a pre-specified ratio. Now, when I issue the bond, it doesn't make sense for you to convert because I'm issuing the bond at a price that's going to be much higher than the current stock price. I'm not going to do that. But if the price shoots up, you could convert. That's what happened, for instance, with AMC convertible debt when the price shot up a couple of weeks ago. The convertible debt holders, which happened to be Silver Lake, a hedge fund, converted the debt because the equity had gone up so much. So let's say you have convertible debt in your company. You have $125 million of convertible debt. That's a face value. It is a 4% coupon rate. So 4% of 125 million means you're going to collect 5 million in coupons every year. And it's a 10-year bond. So if you just sat there and collected coupons, you're going to get 5 million every year for the next 10 years, 125 million at the end of the 10th year. But any time over the next 10 years, you can convert the debt into equity. And clearly, that's a good thing to have. So you're willing to pay $140 million for this debt. Here's what I'm going to try to do. I'm going to try to take the 140 million and estimate how much of it is debt and how much is equity. Here's what's debt. If this convertible bond did not have the conversion option, it'd be all debt, right? So here's what I'm going to do to value the debt portion of the convertible debt. I'm going to take the $5 million coupon, the $125 million face value, and then I'm going to look up what it would have cost this company to actually borrow money in the market today. Let's say the cost of debt is 8%. If they'd just gone out and borrowed money, I'm going to take the 5 million in coupons, the 125 million in face value, discount it all back to today at an 8% interest rate because that's what I'd have paid for this bond. And what I get as a present value, 91.45 million, is the debt portion of the convertible debt. What's a convertible bond trading for? 140 million, right? If 91.45 million is debt, the rest has to be equity, 48.55. I'm going to take the 48.55, put into equity, the 91.45 put into debt. and I'm done. There's no convertible debt for me to worry about anymore. I've made it go away. It's almost sleight of hand, magical thinking, but essentially you've removed a hybrid and broken it up into its components. So when you think about cost of capital, let's summarize where we are. Your cost of equity reflects the currency choice you've decided to make, the business you're in through a beta, and the countries you operate in through an equity risk premium. Your cost of debt reflects your default risk as a company. And it reflects the tax benefits you get from debt. Your weights are market value weights. And you bring them all together, you have an overall cost of funding this company. Any questions about cost of equity, cost of debt, cost of capital before we move into cash flows?
Professor, for a money losing company, in like the first few years, like prior to some assumption of stable growth, what do you use for your cost of debt? Or your your tax advantage, if there is any?
Zero.
Debt?
Zero.
Zero.
If you have debt and you're money losing, just use a tax. So that's you're bringing up a good point, which is your cost of capital can change over time, right? Why? Because your debt ratio can change, your cost of debt can change, your tax benefits can change, your cost of equity could change. So think of this as something you revisit every year rather than doing it once up front and leaving it unchanged. So you can actually have a different cost of capital as you go through time, as each component changes.
I have a question as well. I thought the net operating loss was also kind of could also be used.
It can reduce your tax benefits. So when you reduce your tax, so if you're a company with a big NOL, does everybody know how NOLs work up? If you lose money, you're allowed to accumulate it and carry it forward. So if you're a company with 6 or 8 or 10 billion in NOL, when you borrow money, you actually get no tax benefits until the NOL runs out. One reason when Tesla borrowed money in 2016, I wrote a post saying, I don't understand this. Why are you borrowing money? It makes no sense. Because you can raise equity, you can't talk about tax benefits. There's really no good reason. But if you have an NOL, that factors in as well in how much your taxes will be and what kind of tax benefit you get from that. Okay, so let's talk about cash flows. I'm going to break down the way we think about cash flows into 3 steps. The first step, and every measure of cash flow starts with earnings. Much as I like to dump on accountants, your raw data comes from financial statements. So we're going to start with earnings and look at whether those earnings are a good starting point, whether we need to make adjustments. Second stop, I'm going to ask you, how much of those earnings do you plan to put back into the business? You don't have to, right? But you might choose to put it back because you want future growth. Whether it's in the land, building, or equipment, or R&D, or customer acquisition costs, that's up to you depending on the business you're in. And the third step, if you want to get to cash flows to equity, I'm going to ask, what are the cash flows to debt do you have? How much debt payments do you have? What interest expenses do you have? Earnings, reinvestment, debt payments. And I'm going to take each separately because otherwise it can get very messy in terms of mixing and matching. So let's talk about cash flows. I'm terrified when people say, I've done a DCF. You know why? I have no idea how you got your cash flows. So when somebody says, I've done a DCF, put them on the spot and say, what is it that you mean by cash flows? People look at you and say, but you went to Stern, you have an undergraduate degree in business, you've taken a valuation class, you don't know what cash flows are? I say, I don't know what cash flows are. Tell me what your definition of cash flows is. Because here are the 3 broad ways you can estimate cash flows. 2 of the ways are to equity, cash flows left over after debt payments. The simplistic way of estimating cash flow to equity is look at what companies actually pay out, dividends and buybacks, and say, look, I don't know what the cash flow is, but this is what I got as an equity investor. That's what the old dividend discount model does. It looks at the actual cash paid out. The problem, though, is many companies don't pay out what they can afford to. So you can compute potential dividends. Sounds fancy, but you can look at the cash flows left over after meeting every conceivable need. Debt payments, capital expenditures, working capital. That's free cash toward equity. Alternatively, you can estimate cash flows the entire business, which is a pre-debt cash flow. Here's what I want you to do, and do this after the class. Take the free cash flow to the firm calculation, the free cash flow to equity calculations, put them next to each other. Look at what's similar across the calculations and look at what's different. Let's start with the starting point. Free cash flows to equity start with net income. You know why they start with net income? Because I'm looking at equity investors. Net income is what goes to equity investors. Free cash flow to the firm starts with operating income, earnings before interest and taxes. Why? Because I'm looking at cash flows to the entire business. Starting points are different. Both cash flows, I subtract out what I reinvest, capex, depreciation, working cap, all those things. So basically, the reinvestment is exactly the same in both cash flows. But with cash flows to equity, I keep going, right? I subtract out debt payments. If I borrow money, it's a debt. So when you look across the two calculations, they look different, but essentially you're trying to compute cash flows to different claim holders. Now, along the next few weeks, and even in the valuations you've seen, I often use these words, and especially if you have some experience in discounted cash flow valuation, it can be confusing. For instance, in the three companies I valued so far, I valued Airbnb, I valued GameStop, and I valued Heineken. If you look at how I computed cash flow, I start with after-tax operating income in each one. And then I subtract out this one line item, it says reinvestment. And if you're used to doing valuation in the traditional way, you're saying, where's depreciation? Where's capex? Where's change in working capital? So I'm going to bring these different ways of thinking together so you know exactly what I mean when I say reinvestment. The long way to compute cash flows, you start with after-tax operating income. You add back depreciation. Why? Because it's a non-cash expense. And then you subtract capital expenditures and change in working capital. That's the way I would start to compute free cash flow to the firm. But if you take those items in the middle, capex, depreciation, working capital, you consolidate them, you get reinvestment. So when I talk about reinvestment, I'm talking about capex minus depreciation plus change in working capital. I'm just using a shortcut. Reinvestment is just the word that stands for all of them. And in fact, if I divide that reinvestment by the after-tax operating income, I can state it as a rate. Take a company and work through all three calculations so you're comfortable. So when I talk about reinvestment rates, I'm talking about the same thing you're talking about with depreciation, capex, and working capital. I'm just taking a shortcut because sometimes those shortcuts are actually more effective than working through it the long way. But in doing all of this, I do something that strikes people as change. I start with after-tax operating income. And the way I compute after-tax operating income is I take my entire operating income and notice the word I use, act like I would pay taxes on that operating income. So if I have a 25% tax rate and $100 million operating income, I act like I'd have paid $25 million in taxes. You say, what do you mean act? Because that's not what I do. I get to subtract out interest expenses first before I do taxes, right? When I do cash flows, I act like I get no tax benefits from interest expenses. And that strikes people as odd because interest does save you taxes. In fact, if you ever hung around bankers long enough, they call this an unlevered cash flow. They say this is the cash flow you'd have had if you had no debt. So I'm going to ask a question and let's see if you can give me the answer. When I do my cash flows, I'm ignoring the tax benefits from interest expenses. Why? I mean, those are real benefits. Why am I ignoring them? Brian, you want to try?
I'm not really sure, Professor.
Oh, it's a different Brian. Brian Hogwin? Brian Hogwin, you want to try? I'll help you out. What do I discount these cash flows back at? If it's cash flows to the firm, I discount it back at a cost of capital, right? What goes into a cost of capital? I have a cost of equity. And if you remember with Embraer, I had an after-tax cost of debt. I captured the tax benefit from debt in my cost of capital. The reason I don't count the tax benefits from interest expense in my cash flows, it's already in my discount rate. I don't want to double count. So when you think about where is the tax benefit from debt, it's not gone away, it's in the discount rate. And because it's in the discount rate, I can't count it again in the cash flows. So let's talk a little bit about the mechanics of getting cash flows. As I said, every Cash flow calculation starts with earnings, and your first stop is to make sure that that number is a number you want to build off. So first stop is make sure the number you have for earnings is the most updated value you can get. That's why we talked about trailing 12-month numbers. Don't go with the last 10K. In some cases, you might look at that number from last year and say, I don't want to use that number because something strange happened last year. A lot of you are going to be in that position when you look at 2020 for your company. Why? Because 2020 was a disaster for some companies, right? If you're looking at Marriott, you're looking at Uber, even at Airbnb, 2020 was a bad year. The economy shut down. So what do? Use common sense. We talked about with the interest coverage ratio. When you have a strange year, you look across time to normalize. I'm not saying it's easy to do, but it's something that many of you will have to do in your evaluation is clean up for what 2020 delivered. Update, normalize. And finally, your accountants have left quite a mess. Clean up after them. So I'm going to start with the updating, but the rest of today's session, I want to talk a little bit about what I mean by accountants have left quite a mess and why we need to clean up after them. Let's start with this updating. The fact is, no matter how hard you try, earnings are going to be dated because they're not going to be updated every day. You're trying your best to get the most updated numbers you can. In the US, this is easy to do. You take 4 quarters, you add them up, you got your trailing 12-month numbers. In fact, many data services will report trailing 12-month numbers directly to you. Go to Yahoo Finance, that'll be the most recent year, trailing 12 months. Just use the trailing 12-month data. If you're in a market where your company does not update every quarter, there are a few markets still like that, then your work gets a little more difficult. You have to do the updating yourself. Some numbers you might not be able to update. You're stuck with last year's numbers, but do what you can, update what you can, rather than try to stay stuck with the most recent year's numbers. So the updating is very simple advice. Get the most updated numbers because you want your value to reflect where you are today. But let's talk about the broader problem with accounting. I remember my first accounting class, my accounting professor came in and he put 3 cardboard boxes in front of the room, low-cost props. And he said, in accounting, we're religious about the way we categorize expenses. He said, any expense that creates a benefit only in the current year goes in the operating expense. So when I pay wages to my employees, it's operating. Material costs, operating. Any expense designed to create benefits over many years goes into CapEx. And any expense that's for the use of debt or debt-like financing goes into financial expenses. And he said, we're consistent. I know he was lying because clearly accounting is not consistent. In fact, I'm going to use 2 items in accounting that have been routinely misaccounted for and talk about why they might have been misaccounted and how you would do it right. One of those items, accounting has finally got around to fixing. The item I'm talking about is leases. Leases are a financing expense. They've always been a financing expense. For whatever reason, accounting has fallen into the trap of thinking it's an operating expense. It took them a long time to fix that. But finally, in 2019, they did. So I'm going to start with leases and how to convert them from operating to financial expense. Something accountants are doing in Europe and the US already, but I'll talk about that process. The second is messier. When we talked about at the start of the class, R&D is a capital expense. I want to talk about how to convert R&D from an operating to a capital expense. So let's start with leases. You know what sectors? This is the biggest issue, right? Retail, restaurants. I mean, the Gap at the height of its growth did not own a single store that it operated, leased every single one of the stores, often with 10 and 12-year leases. It entered a contractual commitment to make lease payments, but because of the way accounting worked, those lease expenses were treated as operating expenses. And that makes no sense to me. To me, the essence of debt is you've entered into a contractual claim. You've agreed to make that payment in good times and bad times. To me, the minute you enter that contractual claim, it's debt, no matter what you call it. So here's what I'm going to do. I'm going to displace what the accounting did. So if the accountant took the lease payment and treated it as an operating expense, I'm going to say, no, that's not an operating expense. I'm going to convert how much debt you've taken on in the form of leases. Sounds fancy, but here's all I'm going to do. I'm going to take your lease commitments every year. The commitments are what you've contractually agreed to pay. And I'm going to take the present value of those commitments over time. And what I get as the sum will be the debt value of leases. I know it sounds abstract, but I'll try this out on the gap and you'll see exactly how much of a difference it makes. So I'm going to take your commitments, take the present value, that's going to become debt. And when I do that, I have to redo everything else, right? Because my operating income was based on this assumption of leases being operating expenses. So here's what I'm going to do. I'm going to take your operating income. I'm going to add back the lease expense saying it's not an operating expense. But remember, when I treat a lease debt, I also create a lease asset. Otherwise, my balance sheet doesn't balance. I'm going to subtract out the depreciation you'd have had on that asset. Sounds incredibly abstract. So let's try this. In 2003, I was invited by the GAP's management to tell them what would happen if leases were ever treated as debt, because accounting was already talking about this. It took them until 2019 to actually do it. So I went into the GAP and I said, okay, right now accountants are giving you a freebie, which is when you lease a store, they're not adding to your debt. But I'm going to convert your lease commitments to debt. And the GAP already gave their numbers out as a footnote to the financial statements. In their footnotes, they told me what their contractual lease commitments were for the next 5 years. So if you see that this table right here, those are right out of their annual report. Those are the lease commitments for the next 5 years. And beyond year 5, they gave me a lump sum of 1,965 million. So here's what I did. I took that lump sum and spread it out over 2 years because it's not all going to be paid in year 6. And then I took the present value of the lease commitments that they gave me using the pre-tax cost of debt as my discount rate. Let me explain why cost of debt. If I treat this as a debt commitment, it has to be cost of debt. Why pre-tax cost of debt? Because these lease commitments are pre-tax lease commitments. It's just a consistency argument. What I get as a present value is 4.4 billion. So what are you going to do with that? I'm going to take the 4.4 billion and add it to what the GAP said they had as debt. If you look at their balance sheet, they had 1.97 billion debt. I'm going to tell them, no, you're lying to me. You truly have about $6.4 billion in debt. And I'm going to go restate their operating income saying, your accountant screwed up. I'm going to add back the lease expense and subtract our depreciation. If I do that, I'm going to end up with a different operating income. I'm going to show you the table that I showed the GAP's management, what would happen if leases got converted to debt, because I'll tell you up front that they went through stages of delirium as I went through this table, from really happy to really unhappy, and you're going to see why. So here, the GAP's management, I'm going to show you what converting leases to debt is going to do to you as a company. So I'll start with the good news. When I capitalize leases, you will become a more profitable company. So right now, your operating income is only 1.012 billion, but if I capitalize leases, I'm going to add back the lease expense and subtract our depreciation, your operating income becomes 1.36 billion. They were very happy. They were more profitable. I said, but I have some bad news. Right now, when I look at your balance sheet, I see only 1.97 billion in debt. But after I capitalize leases, I'm going to see almost $6.4 billion in debt. That's bad news, more debt. So good news, bad news. Then I said, I have some more good news. Right now, when I compute a cost of capital and I use what your accountant tells you is debt, 1.967 billion, my cost of capital is 6.31%. It looks really low. I'm sorry, it's 7.31%. But if I capitalize leases and I bring it into my debt, your cost of capital decreases to 6. By this time, they were just hitting the ceiling saying, this is amazing. We'll make more money. We have a lower cost of capital. Everything's coming up roses. So I hit them with the final piece of bad news. I said, right now, when I compute what you make on your stores as a return, I take the income and I look at the book value of equity and debt, and I count only the accounting debt. The return on capital you make is 12.9%. But if I do capitalize leases and treat it as debt, your return on capital is going to be much lower. It's 9.3%. One way we measure the quality of a company is how much of a return it makes on its projects relative to its cost of capital. Before I capitalized leases, when I looked at the gap, you know what I saw? 12.9% return, 7.31% cost of capital, a spread of almost 5.7%, or 5.6%. After I capitalized leases, when I look at the gap, the spread has dropped to 3%. It's not as good a company as I thought it was. And the way this showed up is when I valued the gap with treating leases as debt, I got a lower value per share than when I valued the company treating leases as operating expenses. You're saying, can I pick either one? No, I think treating leases as debt reflects the truth. And that's why you push towards that number. One final point, and then we'll end for the day. Right? Until 2019, accounting did the wrong thing. I started capitalizing leases in, I think, 1991. In 2019, both IFRS and GAAP finally came to their senses and they said, you know what? Leases are debt. This is good news for you. You know why? Because when you open up the balance sheet for the GAAP today, you will see lease debt already show up. You don't have to go through the process I just went through because they're now going through exactly the same process. I still don't trust accountants. So for the last 2 years, I've been taking what the accountants tell me is lease debt. And I've been doing my own calculation because they still reveal the commitments to see how close I get. And in the US, the good news is I'm within 15%. My lease debt is about 15% higher than their lease debt. But in other parts of the world, the difference is wider, which tells me that companies are starting to play games with the accountants to make their debt not pass the test. So before you come back, come back on Monday, a couple of things I'd like you to do. One is pick a company if you haven't picked a company, obviously. But take a look at their 10K or annual report for the footnotes. One of the footnotes you will find is these lease commitments. So you can see exactly what I'm talking about. And take a look at the balance sheet to see if your company already capitalizes leases, or whether it's something you should be doing. And on Monday when we start, we'll talk about R&D. But that's about it. Thank you very much. And I will see you on Monday.
Thank you, Professor.
Thanks, Professor.
Thank you, Professor.
Thank you.
Thank you. Thank you.
Professor, I have a quick question.
Yep.
So let's just say like I'm looking back 12 months at earnings. I want to estimate earnings going forward. And I say that like, for example, I can't use quarter 1 and 2 of 2020 just because of COVID. Can I look at Q1 and Q2 of 2019 as a substitute or?
Oh, you mean you're going to take pieces of 1 year and pieces of another year, put them together? You could do it, but what's the end game here? It's future earnings, right? It's not getting earnings for last year nailed down. So I'm not sure that'll give you a base year that's that meaningful anyway. So if you're going to do that, I would say just go to 2019, skip 2020 completely. You're better off probably doing that than taking the second half of 2020 and the first half of 2019. So when I valued Airbnb, for instance, I looked at 2019 and 2020, the revenues dropped about 30%. Their earnings became much more negative. When I did my valuation, one of the inputs asked in the spreadsheet is, what's your growth rate going to be in 2021? And I gave them a big growth rate because I saw them bouncing back more towards 2019 revenue. So the 2019 numbers became the driver for what 2021 will bring. And then after you get past 2021, then you're building off a number that's more reasonable. So my suggestion is use 2021 as your year to get them back at least to where 2019 brought, if they're a company that can come back. And then from then on, think about the future of the company, what market it is, what growth that can be, and put that into your forecast.
All right, thank you.
Sorry, I had a quick question too. Just wanted to get your thoughts on, like, this is related to last session, but it's I'm battling Groupon, and I was wondering what you had like thoughts on for the beta, and like what companies I should compare it against.
It's an online retail business, right? I mean, look at Groupon now. That's basically what it is. It's an online retail business that essentially brings together what they call deals. There's really no, if you think about the kinds of products, and it's a wide range of merchandise, right? So I would say my online retail would be my closest.
Yeah. The thing is, isn't it like more closer to advertising because they're not selling a product that they sort of buy?
But how do they make money?
They're having.
They don't charge a fixed advertising fee. They take a percentage of the revenues, right?
Yeah.
Which means that they're going to do well when they're. It would be different if they charged a fixed fee for you to put your product on Groupon. But since they take 3 or 5 or 7% of whatever the merchandising revenues are, you've tied yourself to retail ups and downs. So I think that makes, so that's the difference in advertising and a retail business. In advertising business, I just collect a fee, but I'm not connecting my fee to the transaction revenues.
Okay. So what kind of retailers should I compare it against? Because it seems like
just use online retail. There's a whole bunch of online retailers now, right?
But it's like more geared towards like discount purchasers or like
no, you don't have to even go discount. I mean, it's because Groupon has a range of products. Some are expensive, some are cheap. I don't think I would treat it as a cheap place to shop. It's a place where you can get something cheaper than you would have on Amazon because it's 2 years old or it's not the current style. But it's not the place you go if you're looking for absolute bargain basement, low prices. It's just low on a product where you get higher prices elsewhere.
Okay.
So I just look across all online retail.
Great, thanks.
I have a similar question along those lines.
Yep.
So I'm doing Peloton. So my kind of confusion with Peloton is they have a lot of streaming. So they're like, I guess, Netflix in a way, but also they're not like an average gym. So they don't have too many leases or anything.
If you were valuing Peloton in 2019, what was the original story? Remember before COVID, what was the original story? That it was the equipment that was the front of the business, and people who bought the equipment would pay the $40 a month as a subscription. So it was an equipment company with a very premium subscription model, a luxury subscription model. You know how stories sometimes change? COVID changed the Peloton story. It changed the Peloton story because it essentially opened the subscription business up to become the front business. I have a feeling coming out of this that one of these days Peloton is going to drop. The equipment part is a pain in the neck because you're selling this 2,500. It's a low margin, high infrastructure, all these costs. They charge $13 a month for their just the plain subscription where you don't have to buy the equipment. So, and it's almost all pure profit, right? Because the marginal cost of the additional screen, there's almost nothing. So coming out of this COVID, I think that what you see is a subscription company with a little bit of a fitness equipment part, whereas going into COVID, they're a fitness equipment company with a little bit of side. So it is a subscription business. Is it entertainment or is it health? I think it's more entertainment than health, to be quite honest. And I would think, you were right about the Netflix subscription. It is closer to Netflix than it is to Lifetime Fitness.
Awesome. Okay, thank you.
Welcome.
Professor, I have a quick question.
Yes.
Do you have time?
Yeah.
Yeah, so we talked about the subsidized loan. As a restructuring investment banker, can we kind of negotiate the subsidized cost of debt with the government? Does that usually happen? Like, can the
if the government really wants a company to survive, and you as a banker go in and say, for this company to survive, it needs cheaper debt, otherwise the company has to shut down. The government.
But how do we scale, like measure, like the appropriate subsidized cost of debt? Let's say
you're going to start with zero and work up from there, right?
Okay, so if I just okay, so in the meeting, so I say,
it's a negotiation because there's no right number. It's whatever subsidy. The bigger the subsidy you can extract, is even better. If they gave you a loan and said, "Don't pay me back," that'll be even better. No interest rate, no principal, and sometimes you get that governments will actually give you a freebie up front. Right?
Oh, wow.
So you're starting with that and working up, and how much you will succeed will depend on your bargaining position. If you have a company that's viewed as a crown jewel by the country, they don't want the company to go under. You have
like Rocket Mountain, right? Like government will be willing to give you 0% of cost of debt. Okay, sounds great. Thank you so much, Professor.
You're welcome. Take care. David, you have a question?